Welcome back, my passive income investors. I like to arguably my favorite monthly dividend stock and my favorite dividend stock of all time is zooming out. Of course, I am talking about Northland Power that recently released earnings. Now, this is a natural energy company focused on wind, solar, natural gas, and basically, yeah, it's globally diversified and one of the first stocks I ever bought. And since the earnings release, it's taken a little bit of a kicking here, trading down 15%. We're going to look at the good, the bad, the ugly, and whether you might want to consider picking up this dip. So consider hitting that like button, folks. And let me start by showing you my personal position in this company, which currently today, my 506 shares are sitting up 84%. But this isn't actually that accurate because I used to own this company and other brokerage accounts years ago. And I actually, for the fun of it, because I told you guys it was literally one of the first stocks I ever bought, I went through my trading history and I actually found the nitty gritty details. I initially bought 35 shares of this company at $17.90 back in 2014, right after I bought Tweed for $2.60. That's what Canopy Growth Corp used to be, by the way, folks. But putting that aside, let's dive down into this company's earnings. Let's talk about this here, folks, because I got all of the highlights on Yahoo, and then we're going to get into the more gritty aspect of it. But the sales increased 24% to $2 billion from $1.6 billion in 2019, and gross profits increased by 20%. So still a good growth company by that metric. Basically, the adjusted EBITDA increased by 19%, but where they got hit the hardest was in the free cash flow, which decreased by 2% to $1.73 from $1.77. Now, this was an effect of lost revenues from unpaid curtailments at the German offshore wind facility and the lower wholesale market price at Gemini, which I've talked about in the last earnings report, that I was kind of frustrated that they've been having maintenance at the Gemini project, which is a huge project for them that is continuing to cause them issues into the future, which again, we'll talk a little more aggressively about. But going on their website, folks, just to give you the nitty-gritty details on what I want to show you, because at the end of the day, when it comes to power companies, it's just the power they produce at the end of the day that's going to lead to the most results. So here we can see for the year end, we can see the increase on the revenues we just mentioned from 1.6 billion to 2 billion. For the actual quarter end, we still saw a decent increase. So this company is growing even with some of these issues. And if we scroll to the bottom, the only thing I want you guys to pay attention to is the total gigawatt hours produced. This is the only number at the end of the day that matters. And I'm very frustrated to see that in the last quarter, it actually decreased. Not by much, but enough that I don't like seeing this moving forward here, guys. But at least for the year over year, they went from 9,060 gigawatt hours to 9,455. So at least for the entire year, they built on an extra 455 gigawatt hours, which is pretty great all in all. But don't worry, you do not have to be a power specialist. I'm going to explain to you basically how we're going to add up the future potential of this company and the gigawatt hours they might be able to produce in the coming years, which is going to actually kind of give us some insight into how much the revenues may grow. You don't got to be a genius. I'm really going to simplify this for you guys. But if we scroll down, we can see that the North Sea and the Gemini projects right here, guys, with the North Sea project taking the biggest hit in the last quarter, going from 320 to 299 gigawatt hours. And for the entire year, it has actually decreased. It's been the worst performer of the projects that currently exist here. And yeah, it crushes my heart a little bit. But again, it's just one project. It's nice to know they're diversified. But nonetheless, putting that aside, guys, they just did a big acquisition, a 49% interest in the Baltic Power offshore wind project in Poland, which is going to produce 1,200 megawatts. So we can presume that Northland Power's stake will be about 600 of those megawatts. So if we take that, guys, and this is where I'm going to get real nerdy on you, I went through all of their other projects that they're going to be coming online in the next couple of years. They've got 1, 2, 3 onshore wind projects in New York. In Taiwan, they have an offshore wind project, and then they have a solar project going on in Mexico. And if we scroll through all of these guys, I added up the megawatt hours, so you don't have to. And I took all of them, including their percent holding, because I'm not taking the full megawatt if they only own 60% of that project. And basically, in total, and again, I know you might not understand this, but they're producing 1,680 megawatts that is capable from these new projects. And if we add that up over a year in gigawatt hours, if I did my math correctly, it's going to equate to about 6,520 gigawatt hours. And we take 9.4, add 6 here, guys, and we're looking at about what? 15,000 gigawatt hours capable in the future. So that means we could see an increase on their bottom line revenue in the near term by about 50%. That's pretty crazy, guys. Like, that's super awesome. Even just taking a look at Yahoo Finance here, guys, when you take a look at the growth rate of this company, I mean, this thing is just leaning into the right direction. They're going to be on the United States side with Biden and all of those carbon emission projects. I mean, they're already really popular in Canada because it's a Canadian company. And again, when we're talking about this global diversification here, like, how do you really go wrong? So if you were new to this company, before I tell you when you might want to be buying it, let me just show you a few other interesting details that come along here, more particularly to the dividend, because if you have enough capital, I'm going to show you why this could even get juicier for dividend investors out there, because one of the primary reasons I bought it when I was buying it was I was able to cap in over a 5% dividend yield. And this is not to brag in any way, but currently the dividend yield that I'm getting off of this equates to about $607. Divide that out because it's a monthly dividend, by the way. I'm getting over $50 a month. Now, the reason this is really cool is if you can afford enough shares to equate out the equivalent of 1 share a month, you can set up a drip at a discounted rate. Now, in the States, you're going to have to let me know if you have access to M1 Finance, fractional share buybacks. I'd love to hear if you're able to get away with the same discounted rate. But apparently, as of last year here, guys, they introduced a drip enrollment discount, which means if you have enough money to purchase a full share at the end of a month on the dividend payout, they will pay you out in a share at a 3% discounted rate, which is pretty awesome because at the current discount of the stock trending to the downside, I'm thinking about resetting up the drip to take advantage of this discount because, again, that really starts to add up. But what you want to be aware of as well is this is how the company is raising capital. They're giving you this discount because they're giving you an extra share that dilutes the total shares outstanding, which you can argue is a good or a bad thing. It's never just as clean as you're getting a full 3% discount. You're getting a 3% discount on a new issued share. But nonetheless, guys, something to really consider if you are a dividend investor out there. Now, taking a look at the current dip, when we add all of this up, guys, I still think this company is an incredible buy, but ideally, it would be honestly nice to see this go down about 20%. If we're lucky, we're going to see about another 5-10% hair clip. I don't think we're going to get that lucky because I don't think the earnings were that bad, but if you want, if you're brand new to this, maybe dip your toes in here. I know the dividend yield is only 2.77%, guys, but if you can be patient and this thing can go over a 3% yield and just dip a little bit more, I would be loading the bloody boat here just because, again, the future expectations on these companies, in my opinion, aren't just going to be the projects we see here today. For as long as I've owned this company, guys, they were never this big. This company was barely a $3 billion company when I was initially buying it. And I mean, just take a look at the long-term chart here, right, guys? So you're going to have to be a little patient with this because we're dealing with the hype of end phase and solar and all this stuff. But now that we're seeing some volatility amongst this entire sector, guys, this one, in my opinion, flies under the radar. And there's a reason that I consider it arguably my favorite dividend stock of all time. I'm not selling any shares, and I pass the question off to you. What do you guys think? In that comment section below, is this a company you would buy? Are there any other dividend stocks you're interested in? Because tomorrow, which by the way, if you're interested in Canadian banks, because this is a Canadian company, I will be breaking down their earnings. We just saw BNS post. We're going to see Canadian Imperial Bank, Toronto Dominion Bank, all post tomorrow. So I'm saving the video when we get a bigger picture, but things so far have been relatively juicy. So consider subscribing for that future breakdown. But in light of all this, stay cool, stay awesome, and I look forward to catching you tomorrow, guys.